Welcome back to The Explainer. Today, we're unpacking a pretty incredible piece of financial infrastructure. We're talking about a system designed specifically for a group of entrepreneurs who are, quite literally, the lifeblood of our urban economies, yet they're so often completely left out of the formal banking system. We're going to look at exactly how street vendors are being transitioned into the formal financial world through a remarkably structured government initiative.
Okay, let's dive into this because we all know the pandemic created a devastating economic reality for countless informal workers. Imagine having your daily cash flow just halt. Your stock perishes, your savings are totally depleted. When it's finally time to restart, the biggest hurdle isn't just finding capital, it's the massive anxiety of asset seizure. If you don't own a storefront or valuable property, how in the world do you convince a bank to lend you money to rebuild? How do you secure funding when the traditional system demands collateral you simply don't have? Well, that is the exact challenge this scheme was engineered to solve.
Enter PM SVANidhi, which stands for the PM Street Vendors Atmanirbhar Nidhi, launched back on June 1, 2020, and fully funded by the Ministry of Housing and Urban Affairs. I need to make one thing clear. This isn't just a handout. It's a highly specific flagship microcredit scheme. It delivers a fund-based working capital loan directly to urban street vendors. And the entire architecture here is designed to do two crucial things. First, help these micro-entrepreneurs rebuild their livelihoods post-lockdown, and second, fundamentally build long-term creditworthiness right from the ground up.
So here's our quick roadmap for this explainer. 1. What is PM SVANidhi? 2. Who can actually apply? 3. Unpacking the loan details. 4. The 4-step application journey. And 5. Climbing the credit ladder. Let's get into it.
Section 1. What exactly is PM SVANidhi? So, looking at the official documentation, the whole scheme rests on 3 core pillars. First up, it facilitates a working capital loan of up to 10,000 rupees. That's the immediate financial relief. Second, it incentivizes regular repayment, and honestly, this is where the magic happens, because it shifts informal vendors into reliable, documented borrowers. And third, it actively rewards digital transactions to promote wider financial inclusion. It's a beautifully simple, yet highly effective 3-pronged approach.
Now, what's really interesting about this slide is the overarching philosophy. As the text here outlines, this was explicitly designed to help vendors move up the economic ladder through formal credit. That proves this isn't merely a temporary band-aid for pandemic relief. It's a calculated, strategic pathway to integrate previously invisible businesses into the formal financial framework.
Moving right along to Section 2. Who can actually apply for this?
You might expect a ton of bureaucratic red tape here, but the target beneficiaries are surprisingly comprehensive. Primarily, it's for street vendors who are active in urban areas on or before March 24, 2020. If you hold a certificate of vending or an ID card from your urban local body, you're in. But what if you were missed in a city survey? No problem. The scheme allows for provisional certificates via an IT platform. Even peri-urban or rural vendors who operate within urban limits can apply if they grab a letter of recommendation, an LOR, from their local town vending committee. It literally even covers vendors who had to flee to their native villages during COVID but plan to come back and resume vending. They really designed this to cast a wide, inclusive net.
All right, Section 3. Let's unpack the actual loan details. This is the juicy part.
10,000 rupees. That is the maximum working capital amount dispersed in the very first tranche. And importantly, it isn't trickled out. It's dispersed all at once, in a single tranche, straight into the vendor's bank account to ensure immediate liquidity.
Next up, 7%. This is a 7% per annum interest subsidy. The interest rate itself is set at the bank's standard rate for Mudra loans, but the government steps in and provides a 7% annual subsidy. That gets credited straight back to the beneficiary's bank account, provided they make their repayments on time or even early.
But honestly, the absolute most important number to remember today is 0. Under PM SVANidhi, there is 0 collateral required. There's a 0 margin, which means the vendor doesn't have to scrape together any of their own funds up front just to get the loan. And there is 0 processing fees. Even prepayment penalties are completely waived at 0. Now you're probably wondering, if there's absolutely no collateral, how are banks actually willing to lend? So the crucial point is this acronym, CGTMSE. The Credit Guarantee Fund Trust for Micro and Small Enterprises provides a graded guarantee cover. Basically, this translates technical policy into real-world relief. It means the government is stepping in to absorb the risk. The vendor pledges absolutely no assets, none.
Just to anchor all those numbers we just threw at you, here's the official breakdown right from the source. It confirms the 10,000 rupee maximum, the 12-month repayment period via equal monthly installments, which perfectly aligns with the vendor's cash flow, that 7% interest subsidy, and the crucial nil margin. Seeing it visually laid out like this really highlights just how incredibly borrower-friendly this policy is.
Section 4. The four-step application journey. All applications are processed digitally through the Udya Mitra portal, the official gateway for this scheme. And the paperwork? Incredibly lean. As you can see here, you essentially just need the loan application form from the portal, a demand promissory note, and your vendor ID, like that certificate of vending or the LOR we talked about earlier. That is it.
And the timeline is built for pure speed. Step 1, just submit that application on the portal. Step 2 is a quick document and ID verification by the bank branch. And get this, pre-sanction inspections can actually be waived to speed things up. Step 3 is the assessment and sanctioning directly through the core banking system. And finally, Step 4 is signing the promissory note and getting that single tranche disbursement. The wildest part? This entire process is targeted to be completed within just 7 working days. 7 days.
And finally, Section 5, climbing the credit ladder.
And this brilliantly illustrates the whole ladder concept in action. If a vendor repays that first tranche of 10,000 rupees promptly, they are immediately rewarded with an enhanced second tranche of up to 20,000 rupees. Repay that successfully, boom, they unlock a third tranche of up to 50,000 rupees. It is a literal step up in capital that explicitly rewards responsible financial behavior.
Let's move to this breakdown and see how this builds in practical terms. Your first tranche gives you 12 months to repay that 10K. But when you graduate to the second tranche, not only does your capital double to 20,000, but your repayment window expands to 12 to 18 months. Now the interest rate shifts slightly to EBLR plus 3.25%, but you still keep that fantastic 7% annual interest subvention. You are stepping right up into traditional, sustainable banking frameworks.
Woven through all of this, there's a really strong push to go digital. The scheme actively incentivizes vendors to adopt UPI and other digital payment methods. And why does this matter? Because every digital payment creates a verifiable transaction trail, it builds a permanent, data-driven credit profile that literally proves the vendor's cash flow to lenders, seamlessly unlocking those larger future loan cycles.
Now, navigating this alone can obviously feel a bit overwhelming, but there are dedicated resources out there to help. Organizations like the MSME Consultants provide end-to-end advisory services with absolutely no upfront fees to help vendors through this. They do the eligibility check, prepare the paperwork like the promissory note, liaise directly with banks to hit that 7-day target, and even give digital setup support so vendors can start building their transaction trail. They offer a free first consultation to basically get the ball rolling.
So we've seen how PM SVANidhi totally removes the barrier of collateral, subsidizes interest, and creates this brilliant, clear pathway from 10,000 all the way to 50,000 rupees. It is a remarkably structured tool for real economic mobility. So the final thought I'll leave you with today is this. Knowing that these collateral-free, guaranteed resources are out there just waiting to be claimed, are you ready to take your first step up the credit ladder? Thank you so much for joining me for this explainer. Keep learning, keep growing, and I will see you next time.